Hey, everybody, welcome back to the Financial Freedom Show. My name is Rob Berger, and I realized for this live Q&A, I'd set it up 3 hours ago and marked it as private, which means no one saw it until about 2 minutes ago when I went in and marked it as public. And I see some folks who are already joining. If you can hear and see me, I'd appreciate a thumbs up while I sign into an app that I need to actually make this show work as much as it ever works. Bear with me. I'm going to start today. Oh, thanks, Paul. I'm going to start today addressing just a couple of questions that have come in from some folks who have joined the live Q&A last few weeks, have had questions, but just I never, for whatever reason, I never got to their questions. And so two folks have asked some questions. I want to address their questions, which I think are interesting. And one thing that I find fascinating is that when something happens to us, maybe this is only me, but when you experience something, particularly when it involves other people, and you sort of fill in a story that may or may not be accurate. I'll give you a silly, stupid example. My wife and I were driving home from Columbus today because I went to Ohio to watch the Bengals win the Super Bowl. Okay, didn't quite work out that way, but it was a good game. And we were coming back. We stopped it to get some food, and in the parking lot, right by the front door, there's this nice spot that's open, but we can't park there because there's this giant pickup truck in the spot next to it. But they had parked in such a way they didn't take up two spots. At least I don't think that was their goal. But they were over the line, and basically no one could park in that spot. And immediately my mind started thinking about the guy that owns this stupid big pickup truck, and he's so inconsiderate, and he's taking up two spots. And I started laughing. I thought, Rob, first of all, you don't know that the driver's a guy. Number one, could be a woman, and you have no idea what's going on in their life. Maybe they're just in a hurry. They didn't notice. Maybe they take up two spots wherever they go. You have no idea. But I experienced this with this channel because some folks, if I skip over their question, I think they sort of fill that in with this story that somehow I didn't like their question, or and it's usually just me, it's not seeing it. But it's funny how we fill in stories when things happen to us. I'm as guilty of that as anybody. Anyway, enough chit chat. Let's get to the questions. And by the way, for those joining live, some of you have already started doing this. If you have a question or topic you want me to cover, please tag me at Rob Berger. It shows up orange. And I will have timestamps for the show, usually in about a day. All right. So the first one comes from, I'll say Jay, although I could be mispronouncing the name. And they have three questions. I'm going to cover them all, I think. Well, more or less, you'll see. Here's the first one. I heard about an ESG. I'll tell you what that means in a minute. ESG investing, and wanted to know your thoughts on a portfolio of two mutual funds that we'll look at. They're 40 this August and plan to slowly introduce bonds after they turn 50. So they have two. Their portfolio is two funds that we'll look at in a minute. 50% in each. They're both index funds, but they both are ESG funds. So ESG is environmental, social, or I guess socially conscious, or conscience, or conscious, or sort of social sort of perspective, and then governance. So environmental, social, governance, and the idea is these sorts of funds will invest in companies that do good, or you might think of it the other way: they'll avoid companies that do bad, right? And of course, the question then becomes, well, what is bad, right? And so there could be environmental concerns. So maybe, for example, you don't want to invest in companies that derive most of their revenue from fossil fuels. All right. So you could find funds that are index funds. They will track an index, but they'll exclude fossil fuel companies, as an example, or they might exclude manufacturers of firearms or of weapons, for governments, for war and that sort of thing, or maybe they'll exclude companies that have had a checkered history with labor issues, for example, or that don't have a certain maybe diversity sort of metrics, if you will. And I actually did an article for Forbes on this. Let me just Google best ESG funds. What comes up? Let's see. My article's #1 in Google. I've got that going for me. Here it is. Ben was my editor. So this is just for some context. This is Forbes Advisor. I was actually the founding editor for Forbes Advisor for 2 years, and I turned the reins over to some other folks. And when I did that, I continued just to be a writer for them. And Ben is the editor for the investment section of Forbes Advisor. So I wrote this article again. This is February. Well, it's last updated. I may have. Oh yeah. So this was actually updated. I wrote this, I don't know, 6 months ago maybe. The one thing that I found interesting is that when you look at these funds, you really have to dig into the details to understand their what makes them an ESG fund and how they think about that issue. Because it's not the same. Not all the funds are the same. And so, I thought these were good funds back in the day. I don't invest in any of these, and I've never invested in from an ESG perspective, at least when it comes to mutual funds. When I pick individual companies, I certainly think about the business that they're in and how I feel about that for sure. But from an index fund perspective, this is not this is not an approach I've ever taken, but I understand why some folks would want to. And so let's take a look. Let me go back to the email, the notes that I've got here, and pull up the two funds that Jay was asking about. One is QQMG, and the other is EFIV. So let me just pull those up in Morningstar real quick. QQMG, I'll show you this on the screen in just a second. Whoops, let me try that again. QQMG, which is a NASDAQ 100, but it's an ESG-focused NASDAQ 100. And the other fund, again, I'll show you this in a second, EFIV. So EFIV, which is an S&P 500 ESG fund. And we can look at them. So the first question, let's think about this question in two ways. The first is, if we're going to have a 100% portfolio, and I've gone over my views on that many, many times, I won't cover that ground again. But if we just step back and say, okay, if we are going to have a 100% stock portfolio, putting aside the ESG part of it for a moment, does this make sense? An S&P 500 and a NASDAQ 100. So these are all would all be very large companies, right? US-based, NASDAQ 100, we can go to the portfolio. We're looking at the ESG version, but even if we didn't, it's going to be large growth. We know that. And S&P 500 is going to be a large blend. I assume that's true with the ESG fund as well. Well, where's my blue dot? Well, okay, I'm going to guess it's somewhere in here. I'm not sure what happened there, Morningstar. Anyway, does it make sense to have a portfolio that's 100% stocks, 50% in S&P 500, 50% in the NASDAQ 100? To me, personally, that would be too concentrated. I would want to add some small cap. I'd want to add some international, and that's my approach. I can't say that this is a bad approach. One could certainly make the argument that just an S&P 500. I mean, right? That's Warren Buffett. He had 10% in short-term treasuries, but his portfolio for his wife, is basically all S&P 500. So I certainly can't argue against that approach. And adding the NASDAQ 100, I don't think adds any diversity. In fact, let me pull up the EFT overlap tool that we were looking at last week. I'm just curious what the overlap is between these two funds. So here it is. And again, I got to remember these tickers. QQMG is the first one. And the other one is EFIV. EFIV, we can look at the overlap. There might not be a lot, I don't know. There's not a ton of overlap, at least according to this tool, 37%, and you can look at some of the details. But they're still sort of covering the same large cap US companies. Obviously, NASDAQ 100 is going to be more tech and growth. So that would be sort of before you get to the ESG angle, that would be my concern. I wonder, by the way, why don't we compare QQMG to just the QQQ, right? And yeah, I would expect the overlap is significant. The question will be where what they exclude. And so we can look at performance, right? That's really the question. How does and I'm just going to stick with the QQMG for a moment. How does that compare? And let's just compare this to the QQQ, right? So if we go to QQQ and we go to performance, so this one, I don't know how old. It's not very old, so we're not going to have any data. Yeah, it's a new fund, so I guess that's not going to help us um, to know. So, I generally found that ESG funds typically tended to be slightly underperforming, but that's a gross generalization. So, I guess I would say this. I guess two things. If you were comfortable with a 50% portfolio S&P 500 and 50% Nasdaq 100, I don't see any issues with going with these ESG funds. I didn't look at the fees. We should do that briefly. Yeah, it's pretty inexpensive. Uh, so, but you can. I think if you're going to go the ESG route, you have to be willing to accept some underperformance. I'm not saying it will underperform, but at least from my research, a lot of them did when you compared them to a comparable fund. The second thing I'll say is it's really important to look these funds up on the website, on the fund website. So I'll do that for this one just to show you. Let's see. Here it is. And the reason I say that is because I'm just checking the chat here, make sure everything's good. No audio video issues. The reason I say that is you want to understand the ESG angle. What makes this fund ESG? And you can find it, it's not too hard. And here you go. These are the things that they sort of avoid, right? Alcohol, cannabis, controversial weapons. You could get into the detail on that. One thing you'll find when you dig into this is there's usually a revenue cutoff. Like they'll say the company can't earn more than whatever 50% of its revenue from some of these things. It doesn't necessarily mean the companies that are in this fund don't have any connection with any of these things. So, I will say before we move on to the next question, I get a little troubled. Like, for example, what about Coke and Pepsi? They by and large make products that are terrible for you. I don't think they hit any ESG criteria that I'm aware of. Put McDonald's in the same basket. So, I guess we each, there's no right or wrong here, really. It's just a matter of making your own decision. So my concern with the portfolio is probably more the fund selections and what they exclude, like small cap and international, than it is the fact that Jay kind of wants to go the ESG route. All right, real quick, a couple other questions. Jay asked, in a Roth, this is an interesting question to me. In a Roth IRA or 401k, if we sell, they're going to sell one fund, happens to be a Vanguard Growth S&P 500 index fund. They want to sell it and move it into a comparable fund, but that's ESG, right? And they're going to do that when the market is down. Question, does that mean we've locked in the loss? And that was an interesting question because I think the short answer is no. But it's, I guess, maybe a little more complicated. So if you've bought something that's at 100 grand, let's say you put 100, I'm just making a number up, put 100 grand into a fund and you're in a retirement account, so you have to worry about taxes, and it's dropped to 80. So what you want to do is move that money into a new fund. If you're moving it into a fund that covers a similar asset class, so in this case, stocks to stocks and U.S. stocks to U.S. stocks, even. Technically, I suppose you could say you've locked in the losses of the first funds, I suppose. But you're taking the money and you're putting it into a somewhat comparable, U.S. stock index fund. And so to me, that's not really locking in the losses, at least as I use that term. Now, if you took the money out of that fund and bought a bond fund, or put it in cash, and certainly if you went and spent it, then at least by the sort of the traditional use of the phrase, that to me would be locking in losses. But the other thing I'll say is that I always think the lock-in loss concept is misguided. If you've invested 100 grand and it's worth 80, that's what it's worth. Whether or not you should sell, to me, has nothing to do with this concept of locking in losses. Either it's a good investment at 80,000 or it's not. And if it is, you keep it. Or in the case of sort of index funds, if you're going to rebalance or whatever, you're doing that for a certain reason. I don't even really think about it in the terms of locking in a loss. I don't know. I hope that makes sense. So those were the two I wanted to cover that Jay asked. They asked a couple others, but and then many had some questions. I know that you're not crazy about large cap growth. That's true. But what do you think about SCHG? It's a Schwab fund. We'll look at it. And do you think that it would be okay for me or better for my 18-year-old? Well, that's an interesting question. All right, well, let's go to SCHG and take a look. So it's large cap growth. So here's the deal. If we before we even get to that, if we think about an S&P 500, it's a blend, right? It's got value. Companies would be classified as value. Companies would be classified as growth. Kind of got a little bit of everything. So does the total U.S. stock market. Now, if we want to tilt one way or another, the first question is, are you looking to tilt to, let's say in this case, to growth for the next 30 or 40 years, right? Particularly if you're talking about an 18-year-old. If you are and you believe in growth, then that might be a reasonable thing to do. You just have to recognize that there will be times, and by times I mean could be decades or longer, 10 years or longer, where you'll underperform just a regular old S&P 500 portfolio or U.S. total stock market, because growth will underperform for long periods of time, just like value has underperformed for the last, 10 or more years. So you have to just be prepared for that. One reason that I think would be a very bad reason to invest in, I'll show you now, this is just the Schwab US large cap growth. One very bad reason, I think, to invest in this is because it's done well over the last number of years. And it has. We can look at performance. I haven't looked at performance, but it's large cap growth. So it's got to have done pretty well. Not this year, of course. And I can make this a little bigger, maybe. 28%, 39%. I mean, look at these last 3 years. It's incredible. The problem is that returns like this are often followed by returns like this. That's just how markets work. And that's one of the reasons why you need to pick an asset allocation and stick to it. And you're going to have years like this in any individual component of your portfolio. And you're going to have years and maybe multiple years like this. This fund only goes back to 2012, but after the tech bubble burst, you had 3 years that looked like this, except that there were minuses in front of them. And so my concern with this fund and growth in general is I just wonder if we're coming to the end of the growth outperformance that we've seen for the last 10 or so years. But if it's a long-term portfolio and you believe in growth, I think the Schwab fund is a reasonable way to get exposure to large cap growth. The last thing, and then kind of related to that, many asked, why do you favor small cap value over large growth? Is it volatility? No, I never favor something because it's volatile. I might favor something because it's not volatile, but it's just history. And we can look at it. If we go to Portfolio Visualizer and we go to asset allocation, and we'll just compare U.S. large cap growth to U.S. small cap value. And if we run this, so we're looking, you can see here from 1972. What do you think? Who do you think won? I mean, if anyone's looked at this before, you know that it's not even close. So small cap value crushed it, right? 6.7 million to 1.7. And by the way, look at the compound annual growth rate. But over 50 years, that difference, 3%, is huge. It's just huge, right? Well, obviously, you can see the numbers. But that doesn't really tell you the whole story. If we go down here and look at annual returns, now remember, blue is the large cap growth. So look, I mean, it crushed small cap value in 2019. I mean, just obliterated it in 2020. They were even more or less in 21, but now it's interesting. Large cap growth is down more. But so there are certainly years, look at 2017, large cap growth crushed it. But you come back here in the early days of this time period in the 70s and look at some of the small cap value crushed it. So the reason but history is only part of it. I started investing in the early 90s. And that's when I'm starting to learn about asset allocation. And then value really had a pretty outperformance over growth. And it also was just consistent with how I think about investing. And so I've always just, there were times when I had large cap value, small cap value. As I've gotten older, I don't know, over time, I've sort of moved more of my portfolio to the middle. So while I have some value, particularly in my individual stocks, where I get most of my value from, I would say my portfolio overall, if I were to create my portfolio in Morningstar, and maybe I'll do that for a show, but in any event, it would certainly fall in the blend column. So that's my thinking on that. All right. So now I'm turning to the chat. Again, if you want to ask me a question or want me to cover a topic, please tag me. All right. Paul and I have had some good email exchanges, at least if this is the same Paul I think it is. Can you describe your funding source for buying stock? Do you keep money as cash, plan for it, or buy stocks every year? You only mentioned buying Apple, banks in certain years. So that's a good question. So first of all, I only own 4 stocks: Apple, Berkshire, Wells Fargo, and Bank of America. I don't have any plans at the moment to buy more stocks. I'll tell you my approach to this in a second, or kind of as we go. And if I were totally retired, meaning I had no income coming in, outside of investments, then I would not be buying more stocks, probably ever again, actually, because I'd be living off our investments, which would mean the first thing I would do is live off dividends, right? So I wouldn't be reinvesting dividends. I'd be living off dividends in the taxable account and interest. So that would not be a funding source. And I would probably just not be buying stocks. But because my business is making enough money that we can cover our expenses and then have money to invest, at least for now, I don't know how long that's going to last. That's my funding source of my business. And I am moving, each month, profit and loss. I look at the cash flow. What I do, this is probably more detail than you guys care about, but I always keep a minimum balance in my business checking account. So once a month, I go in and I say, okay, hopefully the balance is moved up. As revenues come in and expenses have gone out, hopefully there's something left. And if there is, I'll take the account, I'll move that amount over and above my minimum threshold. I never go below that, to our personal account. And then in our personal account, we have a minimum. I never go below a minimum. And so hopefully we've got more than that. And if we do, it goes to our the broker that we use for our taxable account for stocks. And right now, at the moment, that's going into cash. That's not a ton of money. And it's just, how much I have each month that goes in there. My plan, I have several different plans for that money or ideas. One is, I think I've mentioned, is to buy an index fund, not as part of my overall asset allocation, because this particular account is separate from my asset allocation. It represents, again, about 20% of our portfolio. It's separate from the asset allocation. Everything else is asset allocation. This is separate. But buying a fund that covers an asset class that I think is undervalued. And emerging markets is certainly an option for me as I think about it. And so is small cap or small cap value are two that I'm sort of focused on. But I also may just wait for stocks. And my approach to stocks is to wait until I think I've got a very easy, significantly undervalued company to buy. And the easiest time to do that is when the whole market craters. So think 08, 09, think to some extent the COVID crash. The thing you got to be careful of is just because the market falls by 30% doesn't mean the stocks are a good buy. They're cheaper than they were, and that's true. But we don't want to judge value based on recent price movements, right? But when there's a really sustained bear market for a while, it kind of makes picking stocks, I guess I wouldn't say easy, but easier. I'm trying to make this as easy as possible for me. And the other thing is I'm a focused investor, so I'm not going to invest in a dozen stocks. I've got 4 now. I would find it hard to imagine going above about 6. So I kind of think like I've got two more, purchases to make, maybe. But it might be a year or two. I don't know when. I'm not in a hurry. And I don't even have one of the things I am going to do at some point is come up with a list of companies to kind of track, to kind of keep an eye on, so that if they ever went down at a certain level, yeah, Microsoft would be on that list. Deere and Company would be on that list. I like UPS and FedEx. I like those companies because they're easy to understand. I'm sure they're incredibly complex to operate. You move packages from point A to point B. I can, at least my mind can wrap around that idea. Uh, so they would be on the list. I kind of think those would be unlikely for me. Anyway, and I'm always looking at the companies I own. That's even that's the easy case. If they go down to a point where I think it makes sense to buy more. But anyway, Paul, I hope that answers your question. Okay, Rap Freak. Hey, welcome back. See, some folks have YouTube names that are just kind of hard to forget. That's one of them. Can you? That was that was. I just answered Rap Freak's question. That was his question. That was not Paul's question. See, I am getting old. All right, let me try Paul's question now. All right, Rap Freak. I hope that answered your question, Paul. Sorry about that. Paul's question: will you please talk about M1 versus Vanguard? Which is best? Kind of actually like asking what's better, an avocado or Pringles potato chips. No, that's not a good example. Avocado or blueberries. Anyway, which is best? You mentioned you were going to do a video to discuss your thoughts. That's true. Will you talk about it today? Happy to. So, okay, I'm going to be 100% transparent. I try to be as transparent as I can be. And let's first say it depends on what you're doing. So there's a big difference between a 25-year-old opening up their first IRA and to put $100 a month in, and someone who's 55 or 60 now getting ready for retirement and has $2.5 million, and they're thinking about, they don't have one account, they've got 7. They're thinking about, trust and estates. They're thinking about all the tax complications of retirement, required minimum distributions. How are they going to live off? How are they going to create a paycheck out of their money? And both from just at a high level strategy perspective, what accounts am I going to pull from, and when am I going to rebalance? And then just the practical, am I going to just take the money and move it over to a bank? How am I going to, the mechanics of it, right? The issues are infinitely more complicated. So if I were opening up like an IRA today and it was my only account, I like M1. That's probably what I would do. I think unlike a Robinhood or unlike a Webull or a Moomoo, I'm almost embarrassed to say, is that Moomoo? Is that right? Anyway, I think M1 Finance is designed for buy and hold long-term investors. The other apps aren't. They want you to trade, they want you to buy, sell. And I just don't think that's good for investors long-term. So I'm not a fan of those platforms. Now, in fairness, trying to think, I do have a Robinhood account. I got a free share of Macy's stock, but I've never put money into it. I've never used Webull or Moomoo or the others, so they could be great. And maybe if I used them, I'd have a different view. I'm sort of just basing it on their websites and what I've read and stuff. I prefer something that I think one sort of promotes a buy and hold long-term approach and makes it easy to do. And that's what M1 Finance does, because you can rebalance with a click of a button. Now, when I've helped, now I'm going to be transparent. When I've helped young people, think 20 to 25, they've come to me, I've done this maybe a half a dozen times, I don't know. They've come to me, these are your friends and family. They've come to me and said, I want to open up an IRA, what do I do? Where do I open it up? So I would explain to them Roth versus traditional, and their eyes kind of roll back into their head. It's not that they can't understand this, it's just that, they're not geeks like we are when it comes to this stuff. And I talk them through their options. Without fail, they've all opened up an account at Betterment, right? And I think it's a great choice. Yes, there's an added fee, 25 basis points, I think is the fee, but it does a lot of good things for investors. So I'm a big fan of Betterment. And Betterment's not an advertiser. I should disclose that. I'm trying to get them as an advertiser. Why not? I like to get advertisers that I like. So someday they might be, but they're not right now. But back to your question, as someone, and Paul, I'm trying to think if I remember our email exchanges. I think maybe you're like me on the better side of 50, but I could be wrong. Um, I'm looking at the complications that a retiree has to deal with. So if my choice were Vanguard or M1 for that scenario, I'd pick Vanguard. Right? I mean, M1 just doesn't have the tools yet to deal with all of that sort of thing. Having said that, I probably wouldn't pick Vanguard. I think platforms like Fidelity. I think Fidelity is a great platform, actually. And I'm not talking about their funds. I'm not talking about the mutual funds or the ETFs, but the brokerage platform. Schwab, I think, is better. I'd probably pick Merrill Edge over Van. I'd probably pick just about any major platform over Vanguard. And that may shock some of you. Kind of shocks me to say it. The problem is, so part of it is just, I think these other platforms offer things that Vanguard just for maybe it's just a business reason they don't offer, like a debit card and a bank account. I mean, you could have everything at Fidelity if you wanted to, or Schwab, or Merrill Edge. Merrill Edge, of course, is connected to Bank of America, and so they just are able to provide services that Vanguard can. That's all. And I think I like the websites and apps of these other platforms better than Vanguard. I love Vanguard funds, and don't interpret from this where my accounts are, because that would probably surprise you. But I'm just telling you based on my experience. I've used a lot of different platforms over the years. I even used Scottrade back in the day. The other nice thing about and the Scottrade brings this up because they had offices and they've been they were acquired. I forget by whom. But Fidelity has offices. Merrill Edge has offices at Bank of America branches. What I say? Schwab has offices. Vanguard doesn't. And I think you may not need to go into the office a lot when you're particularly when you get in your retirement, but maybe once in a year or once every other year you're going to need to or want to, and it's going to be really important. It's kind of like a dining room. You don't use it often, but when you do, it's usually a pretty special, important occasion. All right. Next, from Neil. Any thoughts on all the crypto Super Bowl ads last night? To me, it seemed like the late 90s when the dot-com boom was going on. That's a great comparison. I heard I don't know if this is on Twitter, I heard a funny comment that said, that Bitcoin isn't really currency because how many currency commercials did you see on the Super Bowl? Oh, that's pretty good. I mean, crypto is still the thing. Crypto is still a fad. I call it a fad. I don't mean the technology, but the trading of it is still like a thing. And that's how, these companies are making their money. And they want to get as many clients as they can. And they want to, they'd love nothing more for you to get an account and trade 1,000 different tokens. That's going to, Coinbase would love nothing more than for folks to do that. I don't think it will end well for most investors. You can absolutely, as we know already, pick a point in time and say, well, if I'd have bought here and sold there, I'd be a billionaire in Bitcoin anyway, and other tokens as well, for that matter. And that's true. I don't think that makes it a good investment. I mean, to me, it's interesting. What is investing? What would be, what is the definition of investing? And I learned this from Warren Buffett. And I don't remember where he said this, but he said basically investing is putting your money to work with a reasonable expectation of increasing on an after fee basis the purchasing power of your money. Oh, that was a great definition. I mean, that's what it is. So that means lottery ticket is not a good investment. It's not even an investment by that definition. There's no reasonable expectation of increasing the purchasing power of your money with a lottery ticket. That doesn't mean that there won't be millionaire lottery winners. And we can all be happy or jealous of them, I suppose, or whatever. And it's the same way with crypto. There's plenty of crypto Bitcoin millionaires, I'm sure. Or there are, right? We know that. But when crypto is going sky high, no one wants to hear what I've got to say about it, and that's okay. Sometimes I don't want to hear what I've got to say about it. I'm just looking up the Bitcoin price. 42,000. Yeah, it's basically flat lately. It was down, up, now it's back down. Ethereum's 2,900. I don't transparency, right? I own no Bitcoin. I own like two Ethereum for no good reason. That's it. Well, that's not true. I own some Solana, Cardano, and one Metaverse token, but it's a tiny amount, I can assure you. Okay. I can't pronounce this name and I'm embarrassed that I can't, but I'll read the question. Love the show, Rob. What are your thoughts on EE bonds and TFRA accounts? Well, let's look up EE bonds, which I haven't thought about EE bonds in forever. I mean, I couldn't even tell you how EE bonds work. It's been so long since I've thought about an EE bond. So they are 30-year bonds, as you can see, right? I'm trying to highlight it right there. You got to buy them direct. So like you're not going to buy an EE bond ETF, for example, right? Same thing with I bonds, or not. Yeah, I bonds. You buy them direct. Current rate is a paltry 10 basis points. That's not good. That's right. These are the ones that regardless of the rate, if you keep them for 20 years, they'll double. That's a really bad interest rate, right? Right. You just think of the rule of 72. So, I don't know that I would be buying EE bonds right now. I mean, doubling in 20 years is just a terrible rate, right? So yeah, those are EE bonds. And then you wanted to know about TFRA accounts. And someone else asked about this, I think. No, we're talking about something else. So I guess my question is, what do you mean by TFRA accounts? Tax-free retirement account? So do you mean a Roth account? Let me know about that. I'm not going to answer that, but leave another comment and let me know if I've got that right. But EE bonds, I mean, doubling in 20 years is not, of course, all bonds are low yields right now. We know that. Oh, it is tax-free retirement. So let me ask a dumb question. And really no question is dumb. Well, some of mine are kind of dumb, let's be honest. Is a tax-free retirement account different than a Roth? Considered tax-free if there's no federal or state tax due on income earned in the account, both when income is earned and when it's distributed. Okay, are we talking about a Roth? Is there something different that I don't know about? Or is a Roth maybe just an example? No, it's not. It's different. It's a tax-free account. It's a retirement savings account that works similar to a Roth IRA. Huh. I'm going to have to work on that one. I've got it up on my screen on a tab. I'll look at it. I don't want to. I usually can give my opinion whether I know anything about the topic or not. Lawyers are good at that. Okay. Furless Wolf. Can't make these names up. Rob, thoughts on using BSV versus BND or a combo? I've been using BSV since the Fed went to basically 0% rates. I was thinking to move back to BND when the Fed funds rate, I assume is what you mean, is 2%. Check out Fitness Blender YouTube. Huh. Well, I don't know about Fitness Blender, but let's look. We all know BND. I want to make sure I know what BSV is. Oh, you just went short term. Yeah, so I can show you this on the screen. So BSV is Vanguard Short-Term Bond Fund. BND is an intermediate term bond fund. And this is something, I did something similar to this, and I kind of regret it. And the reason I regret it is not because I lost money or in fact, it's probably worked out so far. But really, all we're doing is timing the market, right? We're saying we're saying, look, bonds are expensive right now, so we're going to go to short term. Normally, we'd be intermediate term, but we're going to go to short term, and we're going to do that because the duration is a lot shorter. We can look at it. So this duration is 2.73, right? Which means roughly, if rates go up by 1%, this fund goes down by 2.73% in value. Of course, over time, as it invests in bonds with higher yields, it can make that money back. BND is an intermediate term bond fund. So its duration is about, I don't know, we've looked at this a million times, but 7 years or so. We can look it up real quick. Yeah, 6.86. And the reason I think it was a mistake for me is because I think it violates one of my principles, and that is for my asset allocation, I'm not going to ever time the market. I've got my plan, I'm going to follow it. And, I don't remember when I moved them to short term. Now, again, there are moves and then there are moves. I always ask, am I changing my stock bond allocation? Because that's the biggest change you can make, I think, to your portfolio. And to me, there's got to be a really good reason to do that. And I didn't change my stock bond allocation, but within my bond funds, I didn't get rid of all my intermediate term, but I moved some to shorter term. This was a while ago. I don't even remember when it was. And you say, well, Rob, if you think you did something wrong there, why don't you move it back? Well, I probably will, actually, and probably soon. I was moving accounts around, but part of the reason I didn't jump in to move it back was because I was aggravated at myself for moving it in the first place. Again, I probably didn't lose money, and I probably actually made out a little better because I didn't lose as much as I would have in an intermediate term bond fund. But I just don't like timing the market. And I just think that was a mistake. So but now, having said that, Furless Wolf, one of the things you have suggested in your comment is that you've got an objective criteria for when you'll go back. And that at least answers a question I ask people who regularly time the market throughout their whole portfolio is, well, when are you going to get back in? Well, at least you have an answer for that. But my question to you would be, have you gotten out of stocks? I mean, they're really expensive. And why would you get out of, say, intermediate term bonds? You say it's because they're expensive. Yields are low. Interest rates are going to rise. At least we think. Okay, fair enough. Why are you in stocks? I'm assuming you're in stocks. Because won't the same thing happen, at least in the short term, when rates go up? I mean, we've seen markets just in one day go down 2-3% because interest rates, tick up. The 10-year yield ticks up 10 basis points. So it's just a question. It's a question I ask myself, by the way, too. But I haven't changed my stock allocation at all. VJ from Michigan. Hello and happy Monday, Rob and team from Ann Arbor, Michigan. He really likes to point out where he's from. I was in Columbus this weekend. Anyway, this weekend really wasn't about Michigan and Ohio State, was it? It was about the Bengals. I think they played well. I really thought I thought when he went down, that didn't look good. Of course, Stafford came off limping on one play as well. You see the face? So they missed the face mask. That was a big deal. But they also, I think the Rams got it back because when they had their scoring drive at the end, the first, it was a holding call on the defense. I think was bogus, but it got them a first down. Now there were at least one, if not two, or at least one pass interference call after that was obvious. Anyway. Is there an index like S&P 500 for ESG? Well, we were just looking at it, right? Although I spent most of my time on the NASDAQ 100, but here's one of them right here, the SPDR S&P 500 ESG ETF. And what we can do for the overlap, EFIV, so we can do EFIV, and we can just compare it to SPY. Yeah, so you would expect there to be a lot of overlap, right? But there, obviously there are differences. I think if you sign in and maybe get a membership here, you can see the bigger differences because this just shows you the top 5. What you'd really like to see are maybe the companies that are in the S&P 500 that are not in the ESG version. At least that's what I'd want to know. So if you sign up, it says log in or sign up for a basic membership to view the complete list. Well, gee, I guess I could do that, but I'm not going to do it while we're live. but maybe I'll do that for the next show. But you could do that, VJ. Do they have computers in Michigan? Yeah, I'm sure they do. I guess they must, because you're from Ann Arbor and you're on the show. All right. Jeffrey, suppose your mission, should you choose to accept it, I added that part, was to increase your bond allocation by 5% this year in a taxable account that currently has 7% intermediate U.S. Treasury VGIT. Let me make sure I know what VGIT is. Oh, just intermediate term Treasury. Okay. And 3% short-term tips via VTIP. And then he has, what would, it's funny, people put in their WWRD and I'm thinking, what ETF is that? I think that means what would Rob do? But I could be wrong. Let's type in, is there a WWRD? There is not. So it must mean what would Rob do? Well, Rob probably wouldn't put those funds in his taxable account, even though the yields are low. So you're not getting crushed with taxes because you ain't earning much income. But if I were going to put bonds in a taxable account, I would put them in a muni fund, which have taken a hit lately. I own, let's see, which one do I own? I should know this. Schwab. I think I own the Schwab. Do I own the Schwab muni? Tax. I'm looking it up on. Okay, hang on. I'll tell you what I own. Bear with me. I should know this off the top of my head. I just can't remember the ticker. Okay. Not that hard. Okay. I own, oh, that's right. It's not a Schwab fund. That's what was confusing me. I own a Vanguard tax exempt fund, VTEB, in my taxable account. I don't have a lot in it. But, you know, part of the decision to buy a municipal bond fund. So you got to think of a couple of things. First of all, you're buying a municipal bond fund. Forget the taxes for a moment. Do you want to be in a municipal bond fund? I don't mind the added diversity. I would never own this in a retirement account. But so that's the first question. And then whether a muni fund makes sense will depend in part on your tax bracket, right? Because the income you earn is not taxable. So if we want to think about comparing this to a regular nominal bond, you know, not nominal, but like Jeffrey, compared to your VGIT, for example, which would be taxable, at least at the federal level, you know, what this saves you in taxes is going to vary depending on your tax bracket. So there's not just, this may or may not be ideal, but if I were going to increase my bond exposure in my taxable account, this is what I would do. Not necessarily this fund, you know, you could pick a different fund, but some sort of intermediate term. I think this is an intermediate term, tax exempt, which is just a municipal bond fund is what that is. Yeah. You can see it here, municipal. And then there's some cash. That's, you know, you're asking what would Rob do? Well, that's not what Rob would do. That's what Rob did. Whether it'll work out or not, I don't know. Okay, Kentora. By the way, did anyone go to the Super Bowl? So I want to go to a Super Bowl. That's a bucket list item. I also want to go to football games at what I consider to be awesome stadiums, and SoFi Stadium would be high on the list. That thing looks beautiful. I'd like to go to Dallas. A number of stadiums I'd like to see. Like, I assume they give tours. Like, I like to go do the tour. And then go to a game. One of my other bucket lists is I think I would be good in those progressive commercials about trying to avoid being your parent. I think I could maybe even be the guy teaching him. Like if he doesn't work out long term, I think I could take over that role. I can pronounce quinoa. I got that going for me. I think I've pronounced it right. I eat it every day. All right, Kentora. I've added a number of items to my nutritional list of things to eat. Avocado toast. I know it's so cliche, really, but yeah. And overnight oats. I got a nice thing going on there. I know I'm old. All right, Kentora, does a retiree really need 1 to 3 years of cash if they have 10 years bonds? Bonds hold up well historically when stocks take a dive. Why not just pull living cash quarterly from best performer? Well, I agree completely with you. I don't think retirees need 1 to 3 years in cash. I don't plan to have 1 to 3 years in cash. Excuse me. I don't know that I would just pull. Well, I might pull from my best performer, maybe. I mean, taxes would also determine where I pull from. It wouldn't just be performance of an individual investment. So for me, I would factor in taxes. And at the end of the day, if you say rebalance once a year, it kind of doesn't matter where you pull it from. I guess if you did it quarterly, I don't know that I would rebalance quarterly. I certainly wouldn't rebalance quarterly if it triggered taxes. But I guess if you could, it'd probably be too much of a hassle. But I suppose you could take out quarterly, and then maybe rebalance once a year. But once you rebalance, it goes back to whatever your asset allocation is. And once you do that, where you took from doesn't really matter, right? Because it all gets rebalanced. My plan, again, once we get to the point of living off our investments, will be to start with dividends and interest in a taxable account, and then probably then selling shares in a taxable account. And then eventually getting to traditional IRAs, and then eventually to Roths. In our case, there will be Roth conversions. Well, I shouldn't say there will be. There could be. That could change things a little bit. But yeah, I agree with you. I don't think you need 1 to 3 years. I started out thinking I was going to do the bucket strategy, and I did a video on how good the bucket strategy is. And then I started to implement it, and I thought, this is awful. You can't implement this. I don't like the bucket strategy, at least for me. So I agree completely with you. I don't think most retirees, I don't think I need 1 to 3 years cash, and I'm not sure why anybody would, other than to sleep at night. I mean, that's the thing. I was listening to a Tim Ferriss. He was interviewing Cal Newport, Deep Work, that guy. And I forget what the context was, but something they said sort of just triggered this. I listened to a podcast. They say something interesting, and then it sends my mind going in a direction, and I wake up 10 minutes later having no idea what's going on in the podcast. It's like, what happened? But it's that we crave certainty. We don't like uncertainty, which is one of the reasons we don't like too many choices. I think it's one of the reasons that Dave Ramsey is so popular. I get it. People, just tell me what to do. I don't want to make choices, and I want to know if I follow this, I'll be okay. And the reality is, if you follow Dave Ramsey's plan, you'll be okay. At least in my opinion. May or may not be optimal, but you'll be okay. It's kind of like I was doing one of the diets. I was in college. My wife and I did this diet. I don't forget. It wasn't Weight Watchers, but it was one of those things where you buy the meals from them. It's like you don't have to think, you don't have to make choices, and it's certain. You eat just what they tell you to eat, you'll lose weight. We really like certainty, and that's particularly true when it comes to our money. That's why people, get nervous about the market. It's why we buy expensive annuities. It's why some people, get into the whole options and different ways to, when you buy a put, because you're scared the market, you're scared of uncertainty, and buying the put gives you a little more certainty. So I get it. I get it in retirement, but I think we can do things because we're afraid of the uncertainty that actually make our position less stable, right? And having too much cash can be a real problem, I think, long term, in my opinion. Shorty says, love your channel. I watched your HSA video and I have a question. My wife and I are both not covered by our employers, so have a high deductible plan. Should we open up a plan for each of us? Well, I mean, obviously the answer to that's going to depend on your financial picture and all these other potential issues. But I think an HSA is a really good deal. It's you basically get triple tax benefits. You get a tax deduction, although not in all states, but at the federal level, you get a tax deduction for your contributions. It grows tax free. You use it for qualified medical expenses, and it comes out tax free. And you can save even if you're not going to spend it each year, you can if you want to. you can save the receipts. So in some ways, you can think of it almost like a Roth. You can take the contributions of a Roth out, penalty and tax free. Well, as you save up receipts for an HSA, and we've got thousands of dollars now. I don't know, I haven't added it up lately. That's money we could tap anytime we want, totally tax free, or not, right? So I think the HSA is a great deal. It's a health savings account. I always call it a health spending account. I guess I get confused with a flexible spending account. Anyway, I think they're a great deal. And I mentioned in that, well, you watched the video. I think Lively and Fidelity are the two. And there might be other good ones, but I think those are two good places to open an HSA. This is funny. Bingo knows. This is the second live Q&A in a row that someone has asked me this question, but this one got it right. Why do you use the Miss Pac-Man arcade control as your thumbnail? Well, it's the heading of the channel. In the thumbnail, it's only there because I've yet to put a different thumbnail in, which I normally go back and do for these live Q&As. But when I was creating, I'm not very artistic. I know that I'm sure that shocks many of you. And so when I was creating, so the idea of, so let me go to my channel. So the idea of creating some sort of graphic at the top of my YouTube channel to me, it's just a headache. It's not an opportunity for greatness. It's just a pain. What am I going to do? So here it is. So I got to put something up here. And I loved Miss Pac-Man as a kid. I was kind of a Miss Pac-Man champion. I'm just going to, I don't want to brag or anything. And so there it is. I put it up there. That was the reason. Yeah, that's it. Maybe at some point I'll get someone to put something up there that's fancy. I don't know. I get people emailing me every now and again wanting to do my thumbnails for me, for a fee. And the funny thing is, the reason I don't hire them is not because of the money. It's because of it's like an extra step in the process. If I want to do a thumbnail where I got my mug up there and then some words, I don't always add words. Sometimes it's just me talking, Google picks the thumbnail. But if I'm going to do one, it takes me 2 minutes, and I can usually do it while the video is uploading to YouTube and it's done, rather than, I don't know, slacking someone, or, they watch the channel, they see the video, then they create the thumbnail, then they email it to me, and then I go, not going to do it. G Branding says, I'm 28 and conservative with money. I went from all weather to 25-75. So I'm assuming that's 25% bonds, 75% stock. Oh, yeah, no, 25% stocks, 75% bonds, I'm assuming. Being cautious. I'm now dollar cost averaging 90-10. S&P 500 and feel better than ever. Can you talk about the, psychology that comes with risk conservative portfolio? I think that's what you mean. Well, we have to understand that no matter what we do, there are risks, right? There's just some risks we feel more than others. That's the real risk, is that we're afraid of the wrong risk. In a 100% stock portfolio, there are risks. In a 100% bond portfolio, there are risks. It's just that in a 100% stock portfolio, the risks feel more dangerous. It comes back to certainty. When we're in a bond portfolio is more certain. It's not certain, right? We can lose money in a bond portfolio, as we've all seen this year, but it's more certain. It's less volatile. On the certainty scale, if this were like dead certain, like death and taxes, and this was the opposite, stocks are in here and bonds are over here, right? And so bonds give us more certainty of outcome. But this is probably a silly analogy, but it's one I think of. If you said, look, I'm really afraid of flying, but I need to get from DC to LA for the Super Bowl Sunday night at 6:30. Well, we'll assume that it wasn't just played. And I'm afraid of flying because I don't want to crash and die. So I'm gonna drive. And let's just assume for a moment that driving is safer. That's probably not true. I don't know. There's statistics, whatever. But let's just assume it's safer. Your chances of dying are less driving across the country than flying. Let's just assume that. And so you say, look, I want to get there. I want to be as risk-free as I can be, so I'm driving. And I say, great. The problem is it's Sunday at noon. The game's in 6.5 hours. So you've dealt with one risk, this risk of crashing and dying. Good. But what you haven't factored in is this other risk. You ain't going to get there on time. Okay. And that's kind of defeats the whole purpose when you show up, what, Monday night? I don't know how long it would take to drive across the country. And I kind of see bonds and stocks the same way. You can get too conservative and it addresses one risk, the uncertainty, the volatility of the stock market, but it introduces a whole nother risk. And that is you won't meet your goals of, let's say, buying a home or retiring or sending your children to college. So you introduce these other risks that may not seem so scary at the moment, but long term actually are 10 times worse. And so I think the key is to figure out how to live with the stock market volatility. And that's not easy. And how you do it can change over time. Your risk tolerance can change over time. It sounds to me like you're doing the best you can. You were nervous. You're 90-10 DC dollar cost averaging back in at 90-10. And I don't have any issue with that. You're trying to figure out how you can have the right amount of stocks in your portfolio and still sleep at night. But again, the thing I would stress is a portfolio that's too conservative is not risk-free. It just is exposing you to a different risk. Your portfolio, in fact, it may be that not only does your portfolio not meet your goals, like say you want to retire when you're 65 or whatever, it might not even get you returns that match inflation, at least not right now. So you're actually guaranteed to reduce the purchasing power of your money. So yeah, I think the way you're trying to address it may be the best way for you. We all have different ways. My approach was to, one, understand the long-term view of investing, to understand that over my investing lifetime, stock markets are going to go through some brutal contractions, that when those happen, they're almost never done in isolation. There's always some bad thing in the world going on, like a pandemic or a war or a housing market and banking system collapse. There's always something. I'm reading John Quincy Adams, right? I'm almost done. You guys are probably tired of hearing about John Quincy Adams, but I will tell you, I think the absolute best presidency ever was the 16 or so years he spent in the House of Representatives after he was president. Phenomenal what he did. Anyway, it had to do with slavery, by the way, was his primary focus. Did you know he argued a case while he was in the House before the Supreme Court involving slavery? I didn't know that. Some of you, I have no doubt, do. Can anyone tell me what that case was without Googling it, what the case was about? Anyway, we had the big crash of 1937, right? I mean, or not 1837. I mean, these things happen. They've always happened. They'll continue to happen. That was 1837. And a lot of it had to do with government decisions to move a lot of the banking out of a national bank and into local banks that did stupid things with the money. And anyway, they happen. So that was sort of, for me, sort of realizing this is what's going to happen. When that happens, it's a great buying opportunity. Doesn't mean I'll necessarily invest more. I might be just dollar cost averaging, but I should take comfort in the fact that every dollar I invest when the market's 50% lower may be a scary time, but I'm buying more of whatever it is, the S&P 500 or whatever. Yeah. And the other thing for me is trying to stay out of debt, or at least keeping my debt manageable, not having lifestyle debt, which I think is probably the most detrimental. But yeah, and recognizing that you never arrive. You never get to a point where I don't have to worry anymore. I've got this thing whipped. I've got this thing figured out. That's probably, when you feel like that, you better check yourself before you wreck yourself, right? I think that's what my son says when I get a little too cocky. All right. Mike, how are we doing on time? We're going to go to 8:30. This is a 1.5 hour show. Thursday mornings at 11 is a 2-hour show. We're watching the morning show. I know it's like already been out. I like it a lot. I don't think the reviews were that great. But you know what I just finished watching, which was really creepy. What was it called? Oh yeah. Archive 81. Is that the name of it? Yeah, Archive 81 on Netflix. All right. Mike, Why choose a Vanguard index fund over a lower cost ETF version? For instance, the VTSAX expense ratio is 4 basis points, while VTI is 3 basis points. Why pay more for index? There's no reason to. I like, so we've, the whole issue with Vanguard and mutual funds and taxes and a taxable account sort of changed my thinking on this. But I like not having to deal with the premiums and discounts and all that. But in a way, that's kind of silly on my part for a couple of reasons. One, the premium I'll show you, we can actually go to Morningstar and take a look at this. So if we go and we put in, were you looking at VTI, right? Yeah. So we look at VTI, there's going to be a bid-ask spread. But because this is such a highly traded, liquid, actually that spread is not insignificant, 34 basis points right now. Whether it's, let's see, its NAV is, so it's actually, it looks like it's actually trading a bit below NAV. So like you'd be happy if you were buying below. NAV is the net asset value. It's the actual value of the assets the fund, the ETF holds. If you're buying below this, you're happy. If you're selling below this, you're probably not happy. It's like, yeah, I don't want to have to deal with that, right? I mean, mutual funds don't have that because you're always buying and selling directly with, in this case, Vanguard at net asset value, right? Now, one thing I'm curious about, let's put these funds into Portfolio Visualizer. I mean, 1 basis point, I don't think, I mean, if you're like, well, I should finish my thought. So the first thing was bid ask, right? But like I said, it's usually not that big, and this is not huge. But the other thing, the reason it kind of makes it silly for me to have focused on mutual funds is I'm not a big buyer and seller. I mean, years go by, and I guess I reinvest dividends. Well, actually, I don't in my taxable account now that I think about it. So I don't reinvest dividends. So I don't buy, I don't sell at all, and I don't buy that much. But I just didn't like to have to deal with thinking about the difference between the net asset value and the price I'm buying or selling. And 1 basis point just didn't seem to me to be a good enough reason to go one way or another. But all things being equal, I get it. We want to be, why spend more when we can spend less, right? I'm just curious what the performance is. Let's see how far back. So it goes back 20 years. And yeah, the ETF has outperformed by 2 basis points. 2. So there you go. I guess you decide, what you think of that. Now, if we go, let's look at this. So this year, the ETF has lost more. Look at that. It's lost 6.06 versus 6.03. Ha! Okay. Last year, the ETF won out. No, it lost out. Look at that. Mutual fund. They won by 4 basis points. I'm pretty sure 71 is more than 67. The year before that, look, the ETF won 4 basis points. Lost there big time. Look at that, 13 bips. So it's not, I guess my point, I'm being a little goofy. My point is, when you're talking about 1 basis point, it's really not a determining factor in my view. And there could be, as we've seen, plenty of years when the mutual fund won out. Over time, as you saw, it lost by 2 basis points. So I can't argue. I think either one is fine. At this point, though, particularly given the tax issue, I'd probably just, in a taxable account anyway, in 401k, it's going to be a mutual fund, right? But in a taxable account, at this point, I probably would just buy the ETF. But again, not really because of the 1 basis point, but I'll take it. But again, I still might underperform the mutual fund. I don't know. Okay. I'll say, I wish I could pronounce this name. I'm sure people smarter than I could. I'm too embarrassed to try. But they ask a good question. What are your thoughts around index annuity products with, this was the question. This was one of the questions I didn't answer from the email. With, I don't know who that person is. Or is that a company? Let me first look this up. I don't like index annuities. I'll tell you why in a second. What is this? I don't know, but when I put it in Google and it suggests, gives you the search suggestions, it's this company followed by the word complaints. So I don't know what that means. Is it a company? Yeah. Athene, I guess. I don't know if I'm pronouncing it right. Athene, I guess. Agility. Here it is. I don't want to answer your question. Why are you doing this to me? I am not. Okay, well, they want to take me somewhere else. Okay, there we go. I don't want to go. I don't want to. I want to go here. So these, I don't know what these products are. I mean, I can dig into them. Here's the problem with an indexed. There's a couple of problems with indexed annuities. One is they're expensive. They have fees, and they might try to do things to hide the fees. I don't mean that in the sense that there are fees and they lie to you and say there aren't any. But there are different ways that you can sort of obfuscate the fees. I'll give you an example. Schwab, they have intelligent portfolios and they're free. I don't think they have they don't charge. They like Betterment has a fee, 25 basis points. Wealthfront has a fee. I think Schwab intelligent portfolios the underlying ETFs have a fee, but I'm pretty sure there's no sort of management fee. But so you think, well, boy, they're just so generous and kind. Isn't that nice? No. What they do is they force you to keep a certain amount of cash in the portfolio, and they make the fee that way. I got no problems with Schwab making money any more than I do Betterment or Wealthfront. But I just would wish they just charge a fee. Just don't make me put it in cash. And then there's this fee that I can't really understand. Just charge a fee, put it out there, and then don't force me to put it in cash. So anyway, I pulled up their Schwab's intelligent portfolios. By the way, I'm not saying this is a bad, if you want a automated investment service, this might be a good option. I just don't like the way they structure it. Anyway, with indexed annuities, so there's fees, they're expensive. And if you get into one, you can be expensive to get out. But then what they do is, again, goes back to certainty. They will tell you, they might say, for example, you'll never lose money. If the market's below zero, your balance, you won't lose money that year. But there's no free lunch. That costs something. And they typically take their cost from you either by capping your upside, saying anything above 12%, I'm making numbers up, anything above 12% we keep. Or no, there's no cap. We don't have any cap. But and they whisper this part. There's a participation rate. So, if there's 20%, but you only get 80% of that. We keep 20%. And again, I'm just making up numbers. And so I think indexed annuities are a complicated, expensive way to try to get that certainty that I was talking about earlier. And I just don't think that's a good way to go. I think single premium immediate annuities can have a place in retirement, particularly if you get a low cost one. They're not adjusted for inflation, though, so you got to keep that in mind. And I think there's a lot of downsides to even a low cost, plain vanilla annuity. But with indexed annuities, honestly, I can't think of someone that they would be good for, honestly, in my opinion. That's my opinion. Everything I say is my opinion. All right. I don't know specifically Athene Agility, by the way. I might check that out. But when you start to dig into the documents, like the legal documents of an indexed annuity, I practiced law for 25 years, and I dealt with contracts that were thousands of pages long, and these make my head spin. I'm telling you. I haven't read theirs, but okay. Let's see. Vinyl, what do you think of an anti-ESG? If we invest money in stocks that people shun for non-financial returns, shouldn't we get outsized returns? I wouldn't do that either. I personally wouldn't invest in a tobacco company. I guess for ESG reasons. I wouldn't, I understand in an index fund it's going to have tobacco companies, and I'm okay with that. And maybe that's not completely consistent, but I'm not going to invest in a tobacco company. I would invest in an oil company, but I don't. I haven't. I don't think if I've ever invested in an oil company. I don't know. Jock Doc says, good evening, Rob. Steady listener for the past year. Great content and love these evening sessions. O on the ends and HI in the middle, Ohio. Love you, man. Thanks for joining. You and VJ ought to get into a chat. He's from Ann Arbor. Okay. you, I don't know how to pronounce that. Could you make a short video on quarterly estimated tax payments, specifically for selling single stocks in a taxable account that creates some large taxable gains from years of appreciation? Well, I don't know. I can just answer that question. If you have income that hasn't had taxes withdrawn, like, your W-2, your work, they take taxes out. But if you sell a stock that's got a lot of gains, in order to avoid penalties, and there are safe harbors, so there could be situations where you didn't actually have to estimate your taxes, or potentially, I guess, or you wouldn't have to pay them all. You could hit that safe harbor amount where you don't pay penalties, but then you still owe whatever taxes you owe. But honestly, the way I would do it is to call my accountant and say, okay, I've just sold a stock. I made a gain of, I don't know, whatever, 100 grand, whatever the number is. Do I need to pay estimated taxes, which you probably will, to avoid the penalty, in my experience? And they'll calculate it for you. And in that case, where it's a one-time event, I think you'd only have to pay it like the next due date. Like if you have a business like I do and I have income that's not taxed, I pay quarterly. But if it's a one-time event in the year, I would think you would just pay it all at the, well, you could do it right away, but by the next due date. But at this point, I am way out of my league. So I can tell you that you've identified a valid issue, and you just need to talk to your accountant, your tax preparer, I think. I suppose you could dig in and try to calculate it yourself, figure out what your tax liability will be, and what you will have paid for the year, and what you will owe, and then make that payment. I personally probably wouldn't try to do those calculations myself, because there's just things you could miss. Net income tax from the Affordable Care Act. Are you factoring that in, and do you hit it? That's 3.8%. So there's just a lot of things, and I'd be afraid I missed something. So Mike says, I'm starting a side business. I have a Roth IRA already. Could I create another non-taxable account under my business? Well, you can. You can have a business retirement account. Probably the most common is a SEP IRA. It's very easy to set up. And I'm trying to think, I'm pretty sure, but don't quote me on this, that you can contribute to a SEP and a regular IRA at the same time. But don't, you want to confirm that. I think that's right, though. It's got to be. Contribute to SEP IRA and a Roth IRA. Hey, Google might answer our question. Yes, according to Fidelity, you can contribute to both a SEP IRA and either a traditional or Roth IRA, assuming you meet all the requirements. So SEP IRA is probably the easiest. There are others. There's a solo 401k, a simple IRA, particularly if it's just you. You said it's a side business. You don't have employees. I've had a SEP IRA. I'll fund a SEP IRA this year. I'll actually fund one this year for last year, although we won't be allowed to put a lot in. There's a cap. As an owner, there are certain limitations, and then there's a cap. The cap is high. Is it 58,000 SEP IRA contribution limits? We'll do it. No, not deadline. Contribution limits for 2021. 61,000 for 2022 and 58,000 for 2021. But there's a second limit. I want to say it's 20, could be 25% of your income. I know for a regular employee, it's 25%. As an owner, there's a slightly different rule. Again, a tax accountant is really useful. But Mike, you could look into those. Probably a SEP IRA for most side businesses would be my best guess. I've had 401ks for my business. Is that true? Yes. I had a defined benefit plan. That's really complicated and expensive, but a great way to save a lot of money for retirement. But that's a whole nother topic. No one's asked me about a defined benefit plan. And if they ask me now, there's only 11 minutes in the stream. I'll never get to their question. Okay, let's see. JockDoc, completed my internship and residency under the shadow of the Horseshoe in the early 80s and was there for Woody's last season. Now there's some history for you. In the early 80s, well, I probably didn't go to any games. After my father died, I don't think I've been to a game since he passed away. And he died in 1979. I need to go to another game. He and I used to go fairly often. Once a year, maybe, kind of thing. Anyway, let's see. Paul says, what is your opinion of the 95% withdrawal plan on FI Calc? I don't have one yet, but let's see if I can form an opinion in just a couple of minutes. All right, let's see here. We're going to launch the calculator. And what's the 95% rule? Here it is. Learn about this strategy. The 95% rule is a withdrawal strategy with a unique priority. It aims to preserve your initial portfolio value for the entire duration of your retirement. Other withdrawal strategies typically only care about having non-zero. Got it. So using the 95% rule, your annual withdrawals are based off of percentages, and as a result, the strategy will never completely exhaust your portfolio. Let me just stop there. We'll finish looking at this. One thing to be careful about, like let's say you said, I'm going to take out 4% a year. I'm not going to adjust for inflation, though. I'm just going to take out 4% every year. I can never run out of money. Well, that's probably theoretically true, but when you're 92 and you're taking out 4% of $10, it's probably not going to feel like victory. You know what I mean? So even one that doesn't adjust for inflation can run out of money, right? Now, maybe this one's set up so it can't. So let's keep reading. Using the 95% rule, your annual withdrawals are based off percentages, never run out of money. Unlike the percent of portfolio strategy, however, which is what I guess described, it avoids extreme year-over-year fluctuations that can result from withdrawing a direct percentage of your current portfolio. How does it do that? It does this through its namesake rule, the 95% rule. The 95% rule works like this. Each year, you can either withdraw your safe withdrawal rate, I guess typically 4% adjusted for inflation, or 95% of your previous year's withdrawal. What this means is that your withdrawal will only ever drop at most 5% from the previous year, okay, even if the market experiences a sudden and sharp decline. You can smooth out particularly turbulent retirement periods, such as the 30-year retirement period from 30 to 59. Keep in mind that although year-over-year withdrawal fluctuations are reduced with the 95% rule, there can still be substantial fluctuations in withdrawals over the course of the entire retirement. With an initial 4% withdrawal of 40, the smallest withdrawal, is 20? I mean, I don't know how you survive that. Well, there was deflation, so maybe that would explain that. Still don't know how it works. Each year, you can either withdraw your safe withdrawal rate. So does that mean, what's that mean? Typically around 4, I don't know how you define your safe withdrawal rate. I guess you have to put it in here. Each year, 4%. Minimum withdrawal, we got $1 million portfolio. Let's just put in 40 grand. What's that do? This sounds a little hinky to me. I don't know. Is that the right word? You actually still, it's funny. It says you can never run out of money, but you actually do. Right here, the reds. So I'm going to have to learn more about that strategy. I have questions, Paul, but I'm going to have to spend more time than the show allows to dig into that. Jock Doc, I'm going to defer your question because I'd have to read his. I've skimmed his Morningstar review. His question was what I thought about Bingen's apparent market timing strategy. I've skimmed that review, but I'm going to need to look at it. Okay. I don't know that I'd call that market timing. You're right. He did say he has 20% in equities. I guess that is market timing, but every situation is different. And he's in retirement, and maybe he's got so much money he can invest however he wants. You know what I mean? I don't know. But 20% in equities, it's hard for me to imagine doing that ever. All right, let's see. How are we doing on time? 5 more minutes. Okay, Matt. How do you decide between investing credit card rewards and selling the gains for vacation or trips versus hoarding points with a credit card company that won't make a return sitting there? For those of you wondering where in the world this question is coming from, I will log into my M1 Finance account and show it to you. This is the only live account of mine that I actually show. Not that it really matters, I guess. I always use two-factor authentication. I hope you do as well. So I need to type in a secret number that I can actually share with you because it's going to change in about 10 seconds. But what would you care about a random 6-digit number? Okay, here's my account. This is all from retirement credit card rewards. So that's my balance. I'm up 35% in less than a year. That's pretty good. I'll take that. And they're all invested in two of my stocks, Wells Fargo and Bank of America. And so, yeah, every month or every other month, I cash out all my rewards and I move them over here and then invest them. Now, but to Matt's question, so if I want to take a trip, and we go on trips. If I have, let's say, Chase Ultimate Rewards or whatever, I might use them to book the trip if it makes sense to. That's how I can get the most value out of the points or if it's miles. But then what I'll do is take what that trip would have cost me in cash and move it over to the M1 Finance account. Now, the reality is I haven't had to do that. I don't think I've ever actually done that, or maybe I have, but it's only been once or twice in a relatively small amount because I found that I can get good enough rewards just from cash back, and I don't have to worry about the miles and points systems of airlines or hotels or Chase or Amex, and it's just easier. What I do, and this isn't for everyone, but I have an account at Bank of America, and I qualify for their platinum honors tier, whatever it is. And so I have a card that gets me 2.62%, I think it is, on everything, and then 3.5% on a couple of categories. And then I use the Amex, not Amex, Amazon Prime cards. That's 5% at Whole Foods and Amazon. And do I use anything else? I have a separate business card. It gives me 2% cash on everything. And I find that's good enough for me. You have to it's not unlike investing, you have to decide the complexity you want. Some people, they have 20 credit cards. They have every airline, every hotel, their travel, they travel frequently. I know folks that do this and are out of the country 11 months of the year. And so, every situation can be different, but I found that basically with if you exclude my business card, I basically use 2 credit cards. See if I have my wallet on me. I don't. It's in the kitchen. And that gives me plenty of cash back. So I got rid of my Chase Sapphire Reserve card. Now, I have thought about getting a card that would have a hefty fee probably for the travel benefits, for, having access to lounges in airports and getting upgrades at hotels and things like that. And that might be the Amex Platinum card. But which has a hefty fee. But right now, at least, we're just, I guess in part because of COVID, but we're just not traveling enough for that to make sense. I could see at some point getting one of those cards just for the travel benefits. But yeah, that's what I do, and it's worked fine. If I were going to travel with points, that's how I would do it. The nice thing about doing that too is if I'm going to move the cash over to the investment account, it forces me. Sometimes we don't treat points and miles like real money. It's like why they give you chips at a casino, because it doesn't feel like you're losing any. I'm just losing chips. I'm not losing real money. These are just points and miles. Well, no, they're real money, just in a different form. And so if I'm going to move the money over to, in my case, M1, it makes me think, do I really want to upgrade? Do I really, I don't know. Maybe that's stupid. What do you think about that? That's what I do. All right, we got time for one more, and I'll be back Thursday, 11 a.m. John, should I use the same brand of index fund to invest all the time in my 3-fund portfolio, all Vanguard ETFs, or do I mix it up? I don't see any reason to mix it up. I don't think it's wrong to mix it up. You could have one Fidelity fund and an iShares and a Vanguard, or DFA now offers ETFs without having a broker or without having an advisor. So you could mix it up. I just don't see any reason to. I think, particularly as you near retirement, you've invested for a long time. I think there is some advantage to having your money at two or more brokers for security reasons. I've mentioned that in the past. But particularly with ETFs, you can buy just about any ETF anywhere with no fees. So it wouldn't matter that you were at Vanguard and owned a Fidelity ETF or at Fidelity and owned a Schwab ETF. I mean, that's not an issue. It's just like buying stocks, really. So I don't think it's wrong, John, to mix it up. I don't know I can't think of what benefit that would give you. I mean, unless for some reason, if for some reason you really like the Fidelity S&P 500 index fund, but by golly, you want VXUS, Vanguard fund for your international for some reason, right? But short of that, I can't think of a reason why you would do it. But again, I don't think it would hurt anything, right? So, yeah. All right, I do have to, I'll read one more comment. Jeff says, I heard you mention Turkish get-ups. Fantastic. Yeah, Turkish get-ups are great. I was doing Turkish get-up. So a Turkish get-up, you can Google it, but basically imagine that you're laying on your back with one knee up and one arm straight up in the air, like, towards the ceiling, and you're holding a kettlebell. And basically from this position, you have to stand up with the kettlebell above, straight arm above your shoulder. And then you have to lay back down. Now there's of course, a certain way to do this because you don't want to get hurt. And when I started working out 10 years ago, I couldn't have done a Turkish get up I would have struggled just because of mobility reasons to do it with no weight. And that's how you start. I did a Turkish get up with no weight. Or you might hold a towel in your hand or something, just to have something in your hand. They're a great exercise because they exercise your entire body. And I would do, like, a workout for me would be 5 on each side, alternating with a break in between. Depends how much I'm lifting. I got to the point, I was really happy about this. I was doing 24 Ks, which is 53 pounds. I was mixing it with 20 Ks. It's a lot of weight for me. But then with back issues and stuff, I did a Turkish get up the other day with just an 8K, 16 pounds, and the pain in my right shoulder. So I couldn't really do it on that side because of the pain when I'm trying to hold the weight above my head. So I'll probably start doing them from a rack position, which is pretty awkward in a way, but at least I'm still working on getting my shoulder back to functioning. But yeah, Turkish get-ups are, if I can only do one exercise, if I was limited to one exercise, it'd be a Turkish get-up. And if they're done properly, they're safe. Even when my back hurt, I've never hurt my back doing a Turkish get-up. I say that, I hope I didn't jinx myself. Anyway, yeah, no, they're great. All right, gang. Well, I know this hour and a half, at least for me, it goes by fast. This could have been excruciatingly painful for you. And for that, I'm sorry. But for me, man, it just flies by. But I will be back Thursday at 11. Probably have another video, I think, this week. Next Monday, I will not have the live stream because I will be coming back from a chess tournament. So I'll be in the car. But the following Monday, Lord willing and the creek don't rise, I'll be back. I shouldn't miss a Thursday. So I'll be here Thursday at 11 this week, and it should be next week as well. So that'll be good. And love your questions. Keep them coming. And I'll do my best to get to as many as I can each live stream. So there you go. Hope you have a great week. Until next time, remember, the best thing money can buy is financial freedom and a good set of kettlebells.